This is Roman Hartinger from the National Bank of Ukraine. I am the head of the Innovative Projects Unit, and I want to share with you my opinion on central bank digital currencies. Probably many of you have seen the scheme of the money flower designed by the Bank for International Settlements. I reshaped this scheme into the scheme of a CBDC flower in order to better understand how exactly we can use a CBDC. So there are at least three basic criteria which characterize a CBDC. The first criteria is identification, which means if the user of this CBDC is identified or is he anonymous. The second criteria is accessibility, which means if this CBDC is accessible to a limited group of users or to all the users, like to households or to businesses. The third criteria is yield, which means if the CBDC has an interest rate or it doesn't have an interest rate. And according to the combination of these three criteria, we can have the scheme where CBDC can be used for interbank settlements, the scheme where CBDC is an effective monetary policy tool, CBDC, which is an equivalent of an account opened by the central bank, and finally, the retail CBDC, which is a digital substitute to cash. Of course, central banks can mix these criteria in order to create the architecture of their CBDCs, which will reach their strategy policy goals. The development of new technologies is leading to changes in the financial sector, and we are witnessing the digitalization of different financial services, including the sphere of payments. Digital currencies have now a great chance to become the new normal. The growing number and forms of privately issued crypto assets, including stablecoins, which have become a really hot topic since last year due to Libra, is quickly taking this niche in our payments landscape. As a central banker, I have to be aware of the monetary, financial stability and other forms of risks of different nature that such privately issued digital currencies can potentially bring. By the way, these risks were very clearly analyzed by the G7 group on stablecoins in their report. So a properly designed retail central bank digital currency could potentially provide safer payment services than these privately issued digital currencies. Why? Because CBDCs are issued and guaranteed by the central bank, and those monetary and financial stability risks would also be mitigated in this case. But what is really important here is that when talking about risks-free and resilient digital currencies, we don't have to forget about the competition and innovation issues. And I am pretty much sure that the concept of a retail CBDC should include the participation of private market players that would be intermediaries between the central bank and the customers and would innovate and compete the CBDC related services. We can consider CBDC from two different points of view. On the one hand, CBDC is a new form of central bank money alongside with physical banknotes and central bank reserves. On the other hand, CBDC is an innovative payment instrument which can be used for retail payments. Now, let's see. When performing retail payments, people mostly use cash, debit and credit cards, e-money, and instant payment systems. Each of these payment instruments and the methods has its own pros and cons, and probably it's not always correct to compare the effectiveness because each of them can be used in a unique niche or case. But we can take some general criteria For example, speed, cost, safety, user experience, inclusiveness, and look at them from the customer's perspective. Probably most of the customers want their payments to be safe, to be fast or even instant, not so pricey, user-friendly with minimum steps, and inclusive with minimum barriers. So if we want a retail CBDC to be a success, we have to satisfy these criteria, and we also have to offer some additional advantage which other payment instruments cannot offer. What is also important here is that except the customer's perspective, we have the government and we have the payment market participants with their own interests and with their own objectives. So we have to carefully balance the interests of all the participants of the CBDC ecosystem. The National Bank of Ukraine started to analyze the concept of its own CBDC in 2016. We choose for analysis the model where CBDC is a digital substitute to cash, and we called it e-hryvnia because hryvnia is the Ukrainian national currency. 2 years later, the NBU, in collaboration with several FinTech and technological companies from the Ukrainian market, implemented a practical pilot project. Within this project, we created a blockchain platform on the basis of the private blockchain Stellar protocol. Members of the working groups from the side of the NBU and the volunteering companies opened electronic wallets in this blockchain and tested transactions with e-hryvnia. When starting this pilot project, we had several purposes in our mind. First of all, we wanted to test the DLT technology and to see if it's an optimal technology for the issuance and the circulation of CBDC. Also, we wanted to analyze the legal aspects, to analyze the possible impact of e-hryvnia issuance on macroeconomical indicators, and we were considering an optimal business model that would benefit all the participants of the CBDC ecosystem, including customers, including banks, including non-bank financial institutions. The overall outcomes and conclusions of this pilot project are published in a report, which is available on the NBU's website. In February, we hosted the international conference on CBDC with the participation of experts from 15 central banks, from international financial institutions, from banks and fintech companies. And within this conference, we had a panel discussion on the role and the place of e-hryvnia on the Ukrainian payments landscape. So we discussed topics like the possible financial products that can be built on the basis of e-hryvnia, the potential role of banks and NBFIs in the circulation of e-hryvnia, the possible role of e-hryvnia in the level of financial inclusion in Ukraine. The summary of this conference will soon be published, and as a follow-up, this summer we are planning to organize a workshop with Ukrainian banks and fintech companies to discuss the details of the possible architecture and business model for e-hryvnia. I can mention at least three different models of architecture for retail CBDC suggested by my colleagues from other central banks who researched this topic. The first one is a one-tier direct model where we have the central bank issuing CBDC and also providing all the CBDC related services including interaction with customers, including recording of CBDC accounts and transactions, and designing the user interface and providing the point of sale integration. This model looks quite simple and transparent, but it doesn't provide competition and innovation. Probably it may be used in some small countries with low level of private sector development. The second model is a two-tier indirect one, where we also have the central bank issuing CBDC and also operating the core ledger of the CBDC system, but we have private sector companies which act as agents, like agents for the distribution and settlements of this CBDC, which also interact with customers and with merchants. It's essential here that the CBDC in this model is the claim on these companies, which act as intermediaries. The third model is called hybrid because it's like a mixture of two previous models. Here we also have the central bank, which issues CBDC, and we have the private sector companies which interact between the central bank and the customers. But the CBDC here is the claim on the central bank. What model to choose? It depends upon the concrete country, but in any case, the participation and the involvement of the private sector companies opens the door to innovation and competition. It is mid-April now, and probably it's a little bit late to create a CBDC for the current crisis. But some economists propose to consider the implementation of a CBDC in case next disaster hits. Their idea is to use central bank issued money to deliver welfare to citizens during the quarantine. Since people are asked to stay home and not to work, the idea of social payments, helicopter money, or universal basic income has been widely discussed. But the thing is that delivering such payments, either in the form of cash or directly to bank accounts, can be problematic. Why? Because cash may be not the best option during pandemics, and some people simply don't have bank accounts. So the delivery task could be achieved if a central bank issues digital currency and opens CBDC accounts or wallets to the citizens, and people would get access to these wallets using their smartphones or other devices.